In this video, I'm going to cover some of the concepts from Appendix G, which talks about the time value of money. So what is interest? Right? We all know that interest is payment for the use of money. If you put your money in the bank pays you interest. If you need to borrow money, then you have to pay interest to the person you borrowed from. And so when we're looking at transactions that involve interest, the variables we're concerned with are, what is the principal, which is that base amount that was borrowed or the amount that was invested? What is the interest rate? And our interest rates are always annual interest rates. No matter what the scenario is, the interest rate that is provided is an annual rate. And then we're concerned with the time, the number of years that the money is invested or borrowed, or maybe the number of quarters or the number of months, depending on what we're looking at. So what is simple interest? Simple interest is where interest is computed on the principal amount only. So assume you borrow $5,000 for 2 years at simple interest of 12% annually. This means that you would pay 12% interest only on the $5,000 for each of the 2 years. So the total interest that we would calculate would be the $5,000 times 0.12 for 12% times 2 because we're borrowing it for 2 years, and the total interest amount then would be $1,200. Compound interest is where interest is computed on the principal plus any interest that had been earned or owed from prior periods. Most business situations use compound interest. Your bank pays you compound interest, right? Whatever interest you earn in January is added to your balance so that when they calculate the February interest, it includes that amount. Let's look at an example then that compares simple interest to compound interest. Assume that you deposit $1,000 in Bank 2 where it will earn simple interest of 9% per year, and you also deposit another $1,000 in Citizens Bank where it will earn compound interest of 9% per year, compounded annually. Assume in both cases you do not withdraw any interest until the 3 years is up. So in Bank 2, we're getting simple interest. So each year we're getting 9% on that base $1,000. So total over the 3 years, we would receive $270 in interest. In Citizens Bank, we're getting compound interest. So at the beginning of the year, we put that $1,000 in, we would get 9% on that, which would also be the same $90. But now our balance is $1,090. In year 2, under compound interest, we would earn 9% of that balance, which means we would get $98 of interest. And then in year 3, that gets added on, and we get 9% of that, which now we're getting $106 of interest for that year. So then the total amount of interest we would earn under compound interest would be $295. So we earn a little over $25 more under compound interest than we would under simple interest. Now we need to look at how do we calculate what is that amount going to be in the future. The future value of a single amount is when you put money into the bank or an investment now and you look at what is it going to grow to in the future. So our formula here is our future value is the principal amount times 1 plus that interest rate to the exponent of the number of periods. So let's look at an example to make it more clear. If you want a 9% rate of return, we're hoping to put our money in the bank and get 9% on it. Okay? We would compute the future value for 3 years then as follows. We would take the $1,000 times 1 plus the interest rate, which is 0.09, to the third power, which tells us then that if we get that 9% compounded for the 3 years, the value would be a little over $1,200. Okay. Another way to calculate is by using the tables that are provided in the book. So instead of using the formula, we're going to focus on using the tables. So we could go to our tables, and table 1 then is our future value of 1, meaning the future value of a single amount that you put in and then it grows. So again, if we're going to invest our money, we're going to find our 9% interest rate for 3 years, 9% for 3 years, and our factor comes out to 1.29503. And so we could calculate it by taking the $1,000 times that factor, and we get the same amount. Let's look at another example. John and Mary Rich invested $20,000 in a savings account paying 6% interest at the time their son Mike was born. The money is to be used for Mike's college education. So on his 18th birthday, they're going to withdraw it. Okay, so using the table, first we need to find our interest rate. So our interest rate is 6%, and our number of years then is 18, and our principal is the $20,000. So if we go to our table, we're going to go down, we're going to find our 6%, 18 years. Our factor is 2.85434. And then we can multiply the 20,000 times that factor. Tells us that when he graduates, he'll have $57,000. Now let's look at an annuity. An annuity is the receipt of regular even payments. So instead of just investing one amount and letting it sit there, we're going to invest amounts regularly. And so when we're looking at the future value of the annuity, it's a sum of all of those payments, or the receipt of money, plus the accumulated amount of compounded interest for those. So we need to look at our factors, which are our interest rate, the number of periods that are going to be compounding, and the amount of that periodic payment or receipt. Okay, so assume you invest $2,000 at the end of each year for 3 years at 5% interest. So at the end of each year, we're putting in $2,000. We're doing that 3 times, and each of those is earning 5%. Okay, and so what we need to do then is not all of those funds are sitting in the bank for the same amount of time, right? The money we put in at the end of year 1 is going to get compounded for 2 periods, right? To the end of year 2 and then the end of year 3. So the factor that we would use for our 5% here would be the 1.10250, the 2 years. The money we put in at the end of year 2, it's only going to get compounded for 1 year, so we would go up and use the 1.05. And the money that we put in at the end of year 3, it isn't going to have any time to compound because we're putting it in at the end of the year, and so the factor would actually just be 1. And so the total amount that we would get for these investments would be $6,305. Another way that we could look at this is instead of finding each of our amounts and adding them and multiplying them separately, we can use our table number 2, our future value of an annuity. If we look at table number 2, if we look at our 5% rate for 3 years, we actually see that the factor is 3.15250, which matches the sum of all of those factors. So what they've done in table 2 is figure out what the sum would be of the factors so that you can just do one calculation, the $2,000 payment times the factor also equals the same $6,305. Now our annuity works when you're doing the same amount over and over. The same amount is being invested over and over, $2,000. If it's changing, you can't use table number 2. You have to use table number 1 and calculate them separately. Let's look at another example. John and Charlese's daughter Deborah has just started high school. They decided to start a college fund for her and will invest $2,500 in a savings account at the end of each year she is in high school. The account will earn 6% interest compounded annually. So again, they're putting in the same amount 4 times at 6%, so we can use our annuity table because it's the same amount each year. So if we go to our annuity table, we find our 6% 4 years, 4 periods. Our factor is 4.37462. We can then multiply it out and figure out that she will have $10,936. Okay, now let's look at present value. Future value is where you're putting money now and it's growing. Present value is looking at what is the amount now for something you're going to get in the future, assuming that there's compound interest. Okay, somebody is offering to give you $10,000 3 years from now. What is that worth to you today? Right? Knowing that if you had the money today, you could invest it. Right? You could make your own money on that. So if someone's offering to give you money in the future, we have to figure out what is that worth in terms of today's money. So when we're calculating present value, we're looking at what is the dollar amount we're going to receive in the future, what is that length of time, and then what is the interest rate. And when we're talking about present value, a lot of times they call the interest rate the discount rate because you're working backwards in time. And so we're discounting things back. And so our formula then is our present value, the amount that it's worth today, is that future amount divided by 1 plus the interest rate to the power of the number of periods. Let's look at an example. If you want a 10% rate of return, you would compute the present value of $1,000 for 1 year by taking $1,000 divided by 1.10 to the 1 power, and you'd figure out that that's worth $909.09 in today's value. Or another way to think about it is, if I invested $909.09 and I received 10% interest, I would have $1,000 a year from now. So if somebody was offering to give me $909.09 today, or $1,000 in the future, if I think I can get a 10% interest rate, those two options are equal to me. Okay. We could also use tables to calculate present value. So present value of a single sum is found in table number 3. So again, we could take our 10% interest rate for 1 period, we find our factor, our future value times the factor, not divided, also gives us the $900. Okay, let's look at another example. If you received a single amount of $1,000 in 2 years, discount 10%, what is that value? Okay, we could do the calculation with a formula, or we could use our table. If we go to our table, 10% in 2 years, our factor is 0.82645. So we take our future value times the factor, that is worth $826 in terms of today's money. Okay, here's another example. Suppose you have a winning lottery ticket, and the state gives you the option of taking $10,000 3 years from now, or taking the present value of $10,000 now. So which one do you want? The state uses an 8% rate in discounting. How much will we receive if we accept our winnings now? So they're going to give us $10,000. Okay, 8% rate, 3 years. So we're going to take the 10,000 times that factor. That tells us that the amount we would receive now would be $7,938. Here's another example. Determine the amount you must deposit now in a bond investment paying 9% interest in order to accumulate $5,000 for a down payment 4 years from now on a new Prius. Okay, so in 4 years you want to buy a Prius, you need to have $5,000. How much do you need to put in now in order for that money to grow to the $5,000? Okay, so we want $5,000, 4 years, we hope to get 9% interest, so our factor then is 0.70843, which means that if we deposit $3,542 now, we get that 9% interest compounded annually, we would have $5,000 at the end of those 4 years. Let's look at an annuity for present value. Right? So present value of an annuity is there's going to be a series of future payments coming into us. What are those worth right now? And so we have to discount them back, assuming that we're going to have compounding interest during that period of time. So again, we're working backwards in time. So it is necessary to know the discount rate, also known as the interest rate, the number of periods that we're going back, and of course the amount of that periodic receipt of payments. Okay, and again, an annuity is like a regular sum. This is the way car loans work. It's also the way that mortgages work. So this is really good information to know. Okay, so assume that you will receive $1,000 cash annually for 3 years at a time when the discount rate is 10%. So again, it's the same amount over and over. So now we can use table number 4, which is our present value of an annuity of 1. So we're going to take our future value of $1,000, find our factor, 10%, 3 years. Our factor is 2.48685. And that tells us that the value of those future payments are worth, in today's terms, $2,486. Here's another example, and this is actually how we do capitalizing leases. Kildare Company has just signed a capitalizable lease contract for equipment that requires rental payments of $6,000 each to be paid at the end of each of the next 5 years. The appropriate discount rate is 12%. Okay, so we are going to be making future payments. We have to figure out what is that total cost of that equipment right now, because we have to put that asset into our accounting records. Okay, so we have 12%, 5 years. So we're going to find our factor. Then we're going to take the $6,000 times that factor. That tells you the overall value of that equipment then, in terms of today's dollars, is $21,628. Okay, here's another example. In this example it says, assume that the investor received $500 semi-annually for 3 years instead of $1,000 annually. So now we're having discounting and we're going to have our compounding happening twice a year. So for this annuity, our interest rate was 10%, but the 10% is an annual rate. So when we're calculating this, because it's happening twice a year, we're getting 5% 2 times. So we're cutting our rate, we're taking our rate of 10%, dividing it by our number of compounding, which is 2. That gets us 5%. And then we're taking our number of periods, which was 3, and multiplying that times 2 to get the 6. Now our factor is 5.07569, and we can take our $500 times that factor, and it comes out to being $2,500. Okay, and so the reason that you need to understand this is because in the chapter where we talk about planning for capital investments, we go through 4 different techniques: cash payback, net present value, an internal rate of return, and annual rate of return. The net present value and the internal rate of return, they use these ideas of present value. Future money is coming in or future money is going out. What is that worth in today's terms? And so you need to understand, especially tables 3 and 4, how to calculate present values. So I hope you found this helpful. Go through and read the chapter. Make sure you understand this so that you can apply it in chapter 26.